Welcome to Corporate Finance Explained, where we break down the essential topics every corporate finance professional needs to know. This series is narrated by AI, created using CFI's expert training materials, and designed to help you stay ahead in the world of finance. Enjoy this week's deep dive.
Let's start with a scenario that sounds completely impossible, but I promise you it plays out in boardrooms, almost daily. Imagine a company, a high-growth company. Its financial report card looks fantastic, revenue's climbing, net income is healthy, and EBITDA, that metric everyone loves, is positive. The business is profitable, and yet this company is just a few weeks away from completely running out of money, missing payroll. How in the world is that disconnect even possible?
It's the most profound and, uncomfortable truth in corporate finance. Companies don't ultimately fail because they're unprofitable. They fail because they run out of cash. It's the difference between looking healthy on paper and, having enough gas in the tank to actually drive another mile.
That distinction, the difference between being profitable on a spreadsheet and being solvent in the real world, that's everything, isn't it?
It is.
And it's why we are doing a deep dive today into cash flow forecasting. We're all trained to obsess over profit margins, but our sources today make it so clear. Liquidity is the real non-negotiable survival metric.
Exactly. Our mission today is to unpack precisely what that traditional income statement hides from you. We're going to look at how rigorous cash flow forecasting can expose risk months in advance, and what we can learn from companies like, say, Apple and Walmart that manage liquidity brilliantly versus the ones that collapse, like WeWork, where the funding just ran dry.
Okay, let's unpack that, because for most people, profit is the gold standard. I mean, we're taught that if you sell something for more than it costs, you're winning. So if you're winning on the P&L, where does that fatal cash gap come from?
It comes fundamentally from a timing difference. It's all about the timing in accrual accounting. Think of it like this. Profit is your report card. It measures performance over a period. Cash is your bank account balance. It measures what you have right now.
And they rarely line up?
Almost never. Revenue is recognized when it's earned, and expenses are matched to that revenue. But cash only moves when it's physically exchanged.
So if timing is the killer, give us the most painful real-world examples. Where does the cash bleed usually start?
The first, and by far the most common culprit, is accounts receivable. You ship a product, you book the revenue immediately on your P&L, your net income goes up, looks great.
But your
customer has 30, 60, maybe even 90 days to actually pay you. That revenue is not cash for months, but you still have immediate costs to cover today.
And it gets worse on the other side of the ledger, right? Especially for growing businesses. Let's talk about inventory and CapEx.
Absolutely. If you're a growing business, you need more stock. Buying inventory ties up your cash up front. That money leaves your bank account immediately. But that cost, it only shows up on your P&L slowly as cost of goods sold, as you actually sell the inventory.
So your cash is gone, but the expense barely makes a dent on the income statement yet. And it's the same for big capital expenditures.
Exactly the same mechanism. You buy a new machine for cash today, but that expense gets spread out over, say, 10 years through depreciation.
This is where managers who just live and die by EBITDA get totally blindsided.
It's a dangerous oversimplification, because the biggest killer for some of these profitable companies doesn't even touch EBITDA.
Which is what?
Principal debt payments.
Ah.
EBITDA measures earnings before interest, taxes, depreciation, and amortization. So when you make a $1 million payment on the principal of a loan, that is a massive immediate drain on your cash, but it has zero impact on your EBITDA calculation.
So you could be reporting fantastic operational profitability, amazing EBITDA, but still be legally on the hook for these huge cash payments every month to service your debt.
Precisely.
Yeah.
And if those debt payments are bigger than the cash you're actually collecting, you're heading straight for a liquidity crisis.
That's why cash flow forecasting isn't just a treasury exercise. It's a core finance responsibility looking ahead 13 weeks, 26 weeks, or even longer. It's a survival roadmap.
Exactly, not just managing today's bank balance.
So if the P&L and EBITDA are incomplete, what is the core insight a really good cash flow forecast gives you that saves the business?
It reveals timing risk. That is the insight. It maps out exactly when the cash is coming in, when the fixed payments are going out, and most crucially, whether the company can survive the gaps between the two.
It finds the valleys.
It finds the valleys. It helps you anticipate those months where you're going to hit a trough in liquidity and you need to, line up funding or delay a big project.
And to get that complete picture, you have to model cash across those three classic buckets from the statement of cash flows. Let's define those for everyone listening.
Sure. First, you have operating cash flows, or OCF. This asks the most basic question. Is the core business selling stuff, collecting money, paying suppliers, is it fundamentally funding itself?
If that number is positive, the engine works.
The engine works. Then you have investing cash flows, or ICF.
And this is where growth comes in.
Right. This shows how your big growth decisions, like buying property or new equipment, actually consume liquidity. It's not a bad thing, but you have to fund it. If your OCF isn't big enough to cover your ICF, you've got a structural funding gap.
Which brings us to the third bucket, financing cash flows.
This is the life support system, or, the funding strategy. It shows how long you need external capital, new debt, a line of credit, issuing equity to prop up the business while you wait for everything else to balance out.
And when you combine all three and track them, the real risks start to pop out.
Months before a crisis ever hits.
Okay, now that we have the framework, let's look at the success stories, the liquidity champions. We have to start with Apple.
Apple is the masterclass. They consistently generate massive operating cash flow, often far exceeding their reported net income. Their cash conversion cycle is just astonishingly fast.
Why is that? I mean, beyond just having high profit margins, what's the actual cash mechanism they use so effectively?
It boils down to incredible working capital control and the power of upfront cash. Think about it. Apple gets a lot of customer prepayments, like when you buy a gift card or an annual subscription to Apple TV Plus.
Right, that cash hits their bank immediately.
Immediately, long before the revenue is fully recognized on the P&L. Plus, they have so much power over their supply chain. They basically dictate payment terms to their suppliers.
So they collect cash almost instantly from us, the customers, but they get to delay paying their own suppliers.
For weeks, sometimes months. And that immense liquidity, that massive pile of cash, is what gives their management such profound strategic freedom.
They can fund R&D, pay dividends, buy back stock.
And crucially, they can weather any huge shock. A pandemic, a supply chain disaster, without ever having to scramble for expensive last-minute capital. That freedom comes directly from cash discipline.
Another great example is Walmart. Their operating margins are famously thin, so how do they generate such consistent cash if they aren't relying on big markups?
Walmart shows you that cash timing and scale can matter even more than margin size. They achieve this through what's called a negative working capital cycle.
Okay, you have to break that down for us. Negative working capital sounds counterintuitive. It sounds bad.
It sounds bad, but it's actually brilliant. Simply put, it means they're using their suppliers' money, interest-free, to run their business for a little while. At Walmart, inventory turns over incredibly fast. Customers pay at the checkout immediately.
Cash in the door.
But because of Walmart's scale, they have agreements to pay their suppliers weeks, sometimes months later.
So the cash from the sale is already in Walmart's bank account, maybe earning interest before they even have to pay for the goods they just sold.
That's it, exactly. That time lag means their inventory actually acts as a temporary cash generator, not a drain. It creates consistent, positive OCF, even with tiny margins. They are masters of the flute.
Let's pivot to Netflix. For years, they ran with deeply negative free cash flow. It sounds like a total disaster, but they survived and thrived. What's the lesson there?
The lesson is that negative free cash flow can be sustainable if it is forecasted, funded, and strategically intentional.
So it wasn't an accident.
Not at all. Netflix needed massive upfront cash investment for content to dominate the market. Their finance teams had incredibly detailed long-term forecasts that showed the model would eventually mature and flip positive.
In other words, they knew the burn rate, they had capital lined up years in advance to cover it, and they had metrics showing the investment would pay off.
Precisely. And it did. As the business matured, the OCF caught up, the capital spending stabilized, and they shifted toward being a reliable, cash-positive company.
This is where the contrast becomes really shocking. Let's turn to the cautionary tales. Take Carvana. Just a couple of years ago, phenomenal top-line revenue growth. What did the cash flow forecast expose there?
The revenue growth was explosive, yes, but it required an absolutely massive cash consumption machine running underneath. To sell cars, they first had to buy all that inventory.
So they needed huge amounts of cash upfront just to meet the demand.
Right. This created persistently negative operating cash flow, and that was even before you factor in their operating losses and the rising interest expense from all the debt they were taking on.
So the more they grew, the faster they burned through cash. It was a liquidity death spiral.
It was. And when the capital markets tightened, when money got expensive and investors got nervous, they couldn't refinance that debt. The external funding evaporated, and liquidity just vanished. Growth can't save you if the growth itself is draining your tank.
WeWork is another classic. A structural mismatch that cash flow forecasting should have been screaming about from day one.
Oh, WeWork is a textbook case. The entire model was built on long-term fixed lease obligations. We're talking 10, 15, 20-year guaranteed cash outflows.
Which were funded by what?
Short-term fluctuating membership revenue. Sometimes just month to month. Their liabilities were fixed and long-term. Their income was precarious and short-term.
That mismatch between a 15-year lease and a 30-day membership? That's the fatal flaw right there, isn't it?
It's everything. Operating cash flow was always deeply negative because the costs were guaranteed while the inflows were not. Once that external venture capital money slowed down, the whole thing just collapsed under its own weight.
But it's not just startups. Even huge, profitable giants can face this. Let's talk about Boeing. Structurally profitable, but they had to scramble for billions in debt recently. What does that teach us?
Boeing is such a powerful reminder that operational risk translates immediately to liquidity risk. When they have production delays or their planes get grounded, it sharply reduces their cash inflows.
Because customers don't pay until the plane is delivered.
Exactly. But meanwhile, Boeing's massive fixed costs, payroll, supplier payments, they all continue.
So OCF turns negative almost overnight. The cash spigot turns off, but the drain stays wide open.
That's it. Their cash conversion cycle just jammed. It shows that even a historically profitable company can face a sudden liquidity shock that forces them to raise massive amounts of debt just to stay afloat.
That brings us to the practical side of this. If we as listeners are trying to use this liquidity-first mindset, what does good forecasting actually look like? It can't just be one big annual budget spreadsheet.
No, absolutely not. It requires granularity and continuous updates across 3 essential layers. Each layer serves a different purpose.
Okay, let's start with the immediate horizon.
That's the short-term forecast. You're looking at things daily or weekly. This is just tactical survival. It's focused on immediate, non-negotiable needs. Do we have enough cash for tomorrow's payroll, for vendor payments, for that debt payment due on Friday?
And then we move out to the crucial middle ground.
That's the medium-term 13-week rolling cash forecast. This is your early warning system. This is where you move beyond just accounting and start using scenario-based assumptions. You stress test things.
So you start asking those uncomfortable questions, like, what happens if our 3 biggest customers pay us 30 days late?
Exactly that. Or what if a key material cost suddenly spikes? The 13-week forecast is what tells the CEO in week 5 that if a trend continues, you won't make payroll in week 12. It gives you time to act.
And finally, the long-term view.
The long-term forecast. This connects your strategy directly to liquidity. It dictates your CapEx planning, any major hiring campaigns, and it ensures you stay in compliance with your debt covenants months and years down the road. It bridges the gap between today's cash and tomorrow's strategy.
This has been incredibly clarifying. So for everyone listening, the key takeaway is really a simple checklist. First, do not rely on EBITDA or net income alone as a proxy for financial health.
Absolutely not.
Second, build forecasts that reflect real payment timing, the lags in collection, and the upfront costs of growth. And most importantly, monitor liquidity constantly before it ever becomes urgent.
That is the checklist for resilience. When liquidity gets tight, the finance team suddenly becomes the decision center of the entire company. And the professionals who truly understand cash, not just profit, are the ones who lead their companies through that uncertainty.
So if liquidity really is the key to survival, then the value of a company shouldn't just be judged by its earnings growth, but by how long it could sustain itself if all external financing just disappeared.
That is the ultimate measure of resilience. What number is that for the companies you track? That's the real question you should be mulling over next time you look at a quarterly report.
Thanks for listening to Corporate Finance Explained. If you found this episode valuable, be sure to check out more episodes and explore CFI's highly rated courses at corporatefinanceinstitute.com. Don't forget to subscribe for more deep dives into essential finance topics. See you next time.